it seems like we are seeing signs of at least risk sentiment coming back, risk appetite coming back here in the region and even beyond. I'm just wondering, do you think any of this sort of lasts in any way?
I would say it's a pretty tentative return to risk appetite. What we're seeing more broadly is the fact that investors are shifting their concerns away from high inflation and now to weaker growth dynamics. So with inflation likely to remain sticky at uncomfortable levels, that reads as stagflationary dynamics. And stagflation is considered a dirty word in financial markets, and for good reason. Historically, it's a very challenging environment for risk assets. And asset allocation, the advice is to tilt to those markets that offer some form of stagflation protection, excess defensive growth. Within Asia, some markets that stick out, I would suggest Philippines being one of them, Singapore is another.
Well, tell me, okay, in that those countries you mentioned here, what is likely to be the transmission mechanism for stagflation? And isn't a recession perhaps, or a deep slowdown perhaps, more likely to be on the cards?
When we're talking about stagflationary dynamics, specifically the ones emanating from the Ukraine war, we are looking to seek shelter from that negative demand shock by focusing on economies that are net food and energy exporters, those economies that are less reliant on foreign capital, and those economies that still have the policy space to deliver required policy support to cushion the downside. At the same time, we're looking to seek shelter from the negative supply shock by seeking out those economies with relatively lower weights for food and energy in their CPI baskets, as well as relatively lower share of food and energy in their import baskets. And so when we put all of that together, because that is a lot to process, we find that consistently looks like the likes of Malaysia, Singapore. I would add Indonesia, Australia, New Zealand in that basket too are the ones that screen well for those criteria.
The biggest swing factor still remains the dollar. I feel like the days that we have a dollar strength, everything just kind of sells off, vice versa as well. I'm just wondering, do you see that there are drivers that provide more upward risk for the dollar, or do you think it's still overvalued at this point?
It's important to distinguish between the short and the long term. Some of the structural factors that we highlighted in a note that we published on Friday suggest upside risk to the US dollar is likely to continue. That's of particular relevance to the likes of dollar CNH, for instance. Some of those structural factors, first is that our broader measures of annual global liquidity growth, which really greases the wheels of risk appetite, as well as global growth, has flashed alarm bells since June of 2021, and that's consistent with a continued dollar funding shortage, so increased dollar demand. A second factor is that given the geopolitical climate, weaponization of finance cannot be ruled out. It's likely to intensify, and that means even larger dollar funding strains going forward, especially for those entities that need US dollars the most. Some other typical macro factors, GDP growth forecast differentials and rate differentials are in the dollar's favor too.
Yeah, but Sue, okay, talking about the implications of the weaponization of finance, if you will, in the dollar itself, how does the reduction in the Fed's balance sheet, $3 trillion in the next 3 years, affect A, liquidity, B, ultimately what you talked about in those funding, those countries which need dollar funding?
It impacts the dollar liquidity immensely. The Federal Reserve is pretty much the only central bank in the world that can print, quote unquote, US dollars. And so therefore, the removal of that liquidity or printing, so to speak, is very consequential. And we're seeing that with global liquidity metrics going downtown. Likewise, I would say that Fed's messaging could not be clearer. It shows no proclivity to pivot dovishly yet, as the market is hoping for. And that is consistent with the fact that US financial conditions remain looser, even as the rest of the world is seeing financial conditions tighten there.
I guess there are some silver linings, I guess, in China, whether it's how they emerge out of this lockdown in Shanghai, we had the LPR, a little bit better encouragement when it comes to the tech sector as well. Do you think that we actually have reached that bottom in China, in Chinese assets?
Our view with China is that economic growth is likely to continue to trend lower. We're not really seeing any evidence of even a near-term inflection point. Some of the factors that will continue to weigh on Chinese growth, it has continued exposure to a supply shortage of those goods that are in short supply currently, food and energy. It has the continued costs of COVID zero continuing to stack up. We don't see any loosening up in COVID zero, not until at least the Party Congress in November. The risk is it extends out to the official transition in March of 23. The property sector continues to show signs of deterioration or a lack of inflection there. And lastly, the fact that global consumption patterns continue to normalize towards services away from the goods that China produces and exports.